Adobe trades at approximately $225 per share. Under our stated assumptions, that price does not require growth. Our reverse DCF implies approximately 0.7% annual unlevered free cash flow decline over the next 10 years. So is that low modeled hurdle justified, or are important risks missing from the model? To answer that, we run the valuation through three lenses. A reverse DCF reveals what the current price already assumes. A traditional DCF estimates what the business could be worth under bear, base, and bull scenarios. And a price-to-earnings multiple adds context from comparable historical and market anchors when those are available. Three lenses, one conditional verdict. We model Adobe's cash engine as customers to ARPU to gross margin to free cash flow. The template's proposed defense is switching costs. Once a company runs its operations on this platform, ripping it out costs more than staying, and that is what protects the margin. For an upside case to hold, three things must be supported: seat and usage growth, pricing power, and margin discipline. We will test each one later. Before the valuation, the track record. What has Adobe actually delivered? Over the last 3 years, revenue grew approximately 10.5% a year, earnings per share grew approximately 18.2% a year, and reported free cash flow grew approximately 10% a year. Over the same period, reported free cash flow margins have moved from 42% to approximately 41.4%. The most recent quarter adds nuance. Revenue grew 12.7% year over year, broadly in line with its recent trend. The question is whether that continues. You can see it on the chart. The stock has lagged the broader market over this period. That relative weakness is useful context for the valuation. But recent growth is the starting point of this analysis, not the forecast. The question is never what was delivered. It is what the price now requires. At the time of this analysis, Adobe trades at approximately $225 per share for an equity value of roughly $89 billion. Estimated trailing unlevered free cash flow is approximately $10 billion. A traditional DCF starts with forecasts and calculates a value. A reverse DCF does the opposite. It starts with the current market value and solves for the growth rate that makes the price mathematically possible. We use a discount rate of 11.9%, the company's estimated cost of capital, terminal growth of 2.5%, and the company's estimated unlevered free cash flow base. One adjustment first. On its most recent balance sheet, Adobe carries net debt of about $1 billion. We value the operating business, then subtract that debt. The price we solve against is enterprise value, not the headline market cap. The result? On these assumptions, today's price implies an annual unlevered free cash flow decline of approximately 0.7% over the next 10 years. And the picture is not fragile. Move the discount rate a full point either way, and terminal growth half a point, and the implied path runs from about a 2.6% annual decline to 1.1% growth. Even the most demanding corner stays modest. That path takes unlevered free cash flow from $10 billion today down to approximately $10 billion in year 10, 0.9 times the current level. Watch it fade, year by year. Year 1 comes in around $10 billion, by year 5 approximately $10 billion, and by year 10, $10 billion, each year a little lower than the last. Even that reduced path has a real-world meaning. Holding the current estimated unlevered free cash flow margin at 40.8%, Adobe could shrink to approximately $24 billion in annual revenue by year 10, and the price would still be justified. The market is not pricing in a collapse. It is pricing in 10 years of slow decline. The bar is low, and it stays low. But does our own forecast produce the same value? Now I start with $10 billion of trailing unlevered free cash flow and test 3 possible growth paths. The base path starts at 10.3% and fades toward 4.9%. With 11.9% discount rate and 2.5% terminal growth, that produces $407 per share. The bear case starts at 5.7% growth and cuts the forecast unlevered free cash flow level by 8%. It is worth $291. The bull case starts at 13.9% and lifts the forecast unlevered free cash flow level by 5%. It reaches $515. At $225, the stock sits below even our bear case. So what would justify today's $225? Free cash flow would have to follow the 0.7% annual decline the reverse DCF backed out, while our own forecast points the other way. That distance is the expectation gap. The DCF gives us a value. The multiple tells us what investors are paying for it right now. Our final lens is the valuation multiple. Adobe trades at approximately 12.1 times trailing earnings. Based on expected forward earnings, that falls to approximately 8.2 times. The gap reflects the growth analysts already expect. The company's own median across 4 fiscal observations is approximately 38 times. The broader market trades at approximately 24 times on a configured trailing price to earnings benchmark. Think of a multiple as patience. 12.1 times of price for every unit of current earnings. A low multiple is not automatic evidence of a bargain. The question is whether earnings hold up well enough to deserve a re-rating, and that is exactly what the DCF already measured. The discount is mathematically real. The question is whether it is a bargain or a warning. Now the evidence. Seed and usage growth is mixed. Revenue grew 12.7%, but the data does not isolate seed and usage growth. Pricing power is mixed. Revenue growth of 12.7% and reported free cash flow margin of 41.4% do not isolate pricing. Margin discipline is supported. Reported free cash flow margin is 41.4%, 0.6 points below the oldest year. 1 of 3 are supported. Seat and usage growth, pricing power remain unresolved. The verdict remains conditional. Now stress the model. The business risks are growth saturation, competitive pricing pressure, churn in a downturn. The screen translates them into exact valuation inputs. First, cut starting unlevered free cash flow growth to 70% of the base assumption. Fair value falls to $360. Second, reduce the entire forecast free cash flow level by 20%. Fair value becomes $325. Third, raise the discount rate from 11.9% to 12.9%. Fair value becomes $364. Finally, combine all 3 while fading mature growth to the terminal rate. The model falls to $241. These are standardized model stresses, not predictions. They show which assumptions the valuation is most exposed to. These risks do not need to destroy the business. They only need to produce results below what the current price already requires. The standardized stresses show how the valuation moves. The final question is what all 3 lenses say together. 3 lenses. Here's the verdict. Lens 1, the reverse DCF. The price only asks for free cash flow to fade 0.7% a year over 10 years. A lower, implied free cash flow path than the company's recent delivery, but not a guaranteed outcome. Lens 2, our own DCF, $291 in the bear case, $407 in the base case, $515 in the bull case, and the current price sits below even our bear case. Lens 3, the multiple. A clear discount to its own median across 4 fiscal observations. The combined downside case lands at $241, approximately 7.1% above the current price. Add the 3 together and something unusual appears. The price sits below even our cautious scenario, roughly 80.8% upside to our base case. Either our assumptions are too generous, or the market is pricing risks the model does not capture. The gap is a result to investigate, not proof of an opportunity. Our overall verdict, below our modeled bear case. Business quality and investment value are different questions. This conclusion remains conditional on the evidence and assumptions shown. This analysis is a valuation framework, not financial advice. The result depends on the assumptions shown, and you should always verify them and do your own research.